Good morning or afternoon, everyone, depending on where you are watching from, and welcome to today's RAAS Research Group Stock Take webinar. I'm David Taskin. I'll be your host for this session. The purpose of these Stock Take webinars is to provide investors, such as yourself, with an independent analyst perspective on a budding ASX-listed stock, followed by direct insights from the company and management. And you also have an opportunity to ask questions at the completion of both presentations. Today, our focus is on Rice Growers Limited, trading as SunRice Group, ASX code SGLLV. SunRice is a unique Australian agribusiness and FMCG company with a strong heritage in rice, a diversified product portfolio, and an increasingly global footprint. We will be joined first by John Burgess, Senior Analyst at RAAS Research Group, who will take us through his detailed analysis of SunRice. He'll cover the company's financial model, valuation, peer comparisons, and the key risks and sensitivities that investors should be aware of. Following John's presentation, we'll hear directly from SunRice CEO Paul Serra and Group CFO Dimitri Courtelis, who will provide a company update and then, as I said, participate in a live Q&A session. This is your opportunity to ask questions and supplement your knowledge of the company by putting them directly to management. Okay, let's get started. I'd like to now welcome John Burgess, Senior Analyst at RAAS Research Group, who will provide his overview of the SunRice business. John, over to you.
Thanks, David, and welcome everybody. If we go to the next slide, we'll just touch on the agenda for today from me. I thought I'd just give an update, a very high-level update of the earnings of SunRice, and just a reminder of what they do. SunRice has performed very well over the last 6 months from a share price point of view, and we'll talk about why we think that sort of historical discount to peers has been narrowing and why it could narrow further. And we'll look at peers in that context. Touch on rice, obviously, right. While we FMCG sort of stocks we've picked as peers, obviously none of them are rice players. So we'll just talk a little bit about the rice market which differentiates SunRice from the peers. Look at our valuation, and as David said, look at the key risks and sensitivities. So if we go to the next slide, just a reminder. So in order, international rice trading is the largest division within SunRice at the EBITDA line, and it was about 38% of FY25 just gone, which was SunRice on April year end. Within that business, the Pacific Islands is a very big part of the business. It was 46% of revenue in 2025. Middle East 22 and the US 11. The US can vary, and the Middle East for that matter, can vary quite significantly year to year. And it's a very diverse. I've often called it a black box before, but it's a very diversified business. I think they're sourcing from at least 10 countries. They've got operations on the ground in the US and in Vietnam, and obviously there's the Australian leg to it as well. So it's a very diverse business within SunRice. The second largest contributor at the EBITDA line is the corporate business, which basically has a range of assets in the Riverina, storage facilities, packaging facilities, and they charge rice growers, the growers, a fee, I guess, if you like, for using those facilities. And obviously, so the better the volume in terms of the rice crop is, the better utilisation they get of those assets. There's also a charge for using brands that they have across the globe, including the SunRice brand. And a large part of that business is really the charge is really a WACC calculation, and obviously one of the key sort of variables in that WACC is the 10-year bond yield. So there is a bit of a WACC / interest rate play within that business in terms of an adequate return on capital. Next slide. We look at CopRice, which has grown as a percentage of earnings over the last 3 years, 16% of EBITDA in FY25, and it's really a split, simplistically, between a commodity sort of ruminant feed business and then a growing branded business within the business, within CopRice, particularly focuses on pet foods and equine, following the acquisition of Pryde's Easy Feed. So you've got two very different businesses within that division. RAAS Food Group, 13% of EBITDA in FY25. And again, this is a real mixture of a whole range of branded rice products. So, things like crackers and microwavable rice and protein crackers and so on. And there's also a bit of food service exposure there. There's also some exports, and quite a lot of those snack foods are imported. So it's a real, again, mishmash of imports, exports, and a range of snack foods which are growing in innovation. And you'll see those on the shelves. And finally, we have got Riviana, which is 8% of EBITDA in 25. And their brands such as Toscano, Always Fresh, Heart and Soul. And if you go to those sort of entertainment aisles, the pickle, the olives and the pickles and things like that, you'll see a large part of those shelf space is Riviana brands. And almost all of these products are imported, particularly from Europe. So there is a sort of an FX and a freight overlay in that business, which we've seen over the last, which curtailed that business a little bit over the last couple of years. So that's a very high-level rundown of the key divisions within SunRice. As we move to the next slide, David. So this is the share price performance of our selected peer group over the last 3 months, and you can see SunRice has been the second strongest performer, up over 40% in share price terms. And I think historically, to some extent, quite rightly, there's been a sort of a negative focus on market cap and liquidity and the dual class share structure, which has sort of hampered, the rating of SunRice relative to peers. But I think over the last couple of years, we've seen, solid delivery of earnings relative to peers. SunRice, we'll get to it in a few later slides, but SunRice has been one of the very few companies over the last 5 years that hasn't had a significant earnings decline. You'll see the share prices of most other FMCGs seem to have one or two very big sort of swings up and down over that period. So I think there's, I think the business has delivered very solid and sustainable earnings delivery. There's been a lot of work done on, obviously, a strategy of FY30. So there's a little bit clearer idea about the aspirational targets of revenue and margins going into FY30, which I think help people understand the potential. And so I think all those things have started to focus more on the business rather than less on sort of liquidity and share structures. So yeah, and I guess the other thing we haven't, I should touch on, is the M&A. So it's a theme throughout this industry, and most of the peers have made a significant acquisition over the last 5 years. SunRice is no different, and they've made 3 or 4, and again we'll get to this later on, but they've made 3 or 4 acquisitions that have been, that have contributed to earnings. So they're starting to deliver, starting to get a track record of being able to spot good acquisitions, integrate them, and have them EPS positive. And obviously, just this week, there's been inclusion of the ASX 300. So that certainly, on top of the inclusion into the agribusiness index, that certainly helps in terms of investor knowledge and ability to invest in this company. So I think all those things have combined to see that, to get SunRice looked at as a business rather than just some of those historical issues. As we move to the next slide. So as I talked about, I think it's useful to have a look at CAGR EPS, and I like to look at 2 years historical and 2 years forecast. So it's not all forecast. We've got some historical numbers here to look at. And in terms of, and again, some of these numbers are sort of not meaningful, for various reasons, but in most part, that it's a useful exercise. And SunRice ranks in the top half of the ability to deliver CAGR EPS growth. The FY25 number was down we adjust out a whole range of things, and also the tax rate increased in that year, and it's going to be sustainably up in the high 20s from now on, depending on earnings mix. But that was a bit of an anomaly. But you'll see that they rank very well relative to the other FMCG players in terms of delivering that sort of number over the last 4 years. Looking forward into FY30, and Paul will probably touch on this a bit more in terms of the strategy, but certainly the FY30 revenue targets imply about 8% revenue growth to reach those targets from the FY25 base. So, and the comments are that those margins or that revenue is expected to be accompanied by higher margins. So, the implied CAGR EPS numbers are at least 8%. Per annum to hit those 30 numbers, and it's not unreasonable when you look at the last 4 years to think that that can be achieved into FY30, particularly with a balance sheet that SunRice has, and their M&A sort of appetite and history. As we move to the next slide. So as I said before, rice is obviously the key differentiator. SunRice has a large rice exposure, probably about 78% of EBITDA if we look at international plus the corporate division, which obviously makes money through processing and packaging and distributing rice, and then the RAAS Food Group. So it is a rice business at the end of the day. I guess if you look at I haven't got it here, but the historical growth of rice is pretty consistent. It's sort of about 1.5% per year global consumption. So it's it's a staple in a lot of countries around the world. So it really is a staple 1.5% to 2% consumption growing commodity. And then it's a very complex market with various regions growing, having different weather conditions, different harvests, and then requiring to supplements. Shortfalls in harvests or selling excess harvests throughout the world from various countries. So very complex supply chain, but SunRice are very largely involved in that. Prices have been falling over the last 15, 18 months. India had a ban on exports, which they lifted in September 2024, I think, from memory. It could be maybe 23, but and prices have been falling since that that sort of excess supply has come on in terms of global trading, and that sort of that has its positives and negatives. The negatives are it does reduce revenue falls because obviously the price of the product you're selling it falls. The positive is that a lot more regions, particularly in SunRice, where Pacific Islands is a big exposure, a lot more regions, rice becomes more affordable than it was at the higher prices. It also encourages more competition, so there are swings and roundabouts of a lower price, but we'll see in a minute that both SunRice and Ebro, which is the closest peer SunRice, has managed that declining price very well. As I say, that it's a very SunRice has a very well diversified exposure to rice, from rice trading to Australian, distributing and selling Australian crops, which are obviously which are much more premium in nature in terms of the medium grain rice that's sold, and then the rice food business, so the innovation of getting a high margin products using rice, both imported and exported. So as I've said, if we move to the next slide, despite this falling rice price globally, in most of the key sort of commodity grades, both SunRice and Ebro have managed this very well. And this table shows that you'll see that both SunRice and Ebro in their latest half years, so SunRice to April and Ebro to June, both experienced revenue declines in their key rice businesses. But both achieved EBITDA growth. So that fall in rice prices is manageable by these sort of very diversified global players. Next slide. So as we mentioned, SunRice has rallied about 40% in the last 3 months. Despite this, they're still at a discount to peers on an EBITDA basis, about 11%. On close of business prices, I think it was Monday, and then 17% on a PER basis. So, the rally's been strong, but the discount remains. The debt to EBITDA is in line with the peer average. So the debt levels are very, and most bank debt is extinguished now, I believe. Most of the debt is working capital related. And in fact, the DRP was reintroduced, and the take-up was quite strong in the latest dividend, about 50% from my calculations. So the debt levels will look even better going forward if that DRP sort of take-up rate stays, and just strengthens the balance sheet for whatever M&A might be in the pipeline. The dividend yield, obviously, it's come off from its recent levels given the share price, but it's still above average at 4.8%, fully franked. And SunRice has a history of once they increase the dividend to sort of hold that level. There's no guarantee that's the case, but that's the history that dividends aren't sort of increased lightly. One of the big attractions of this business is it's the capex relative to peers, in terms of if we measure it as a percentage of depreciation or revenue, is much lower. I think that's because their assets are probably they don't have to maintain a lot of those sort of the storage sort of facilities and so on as much as some of the other assets that peers have. So it's a relatively low capex business. In recent years, there's been a upgrade to a few sort of lead and packaging plant and so on that spiked the revenue, the capex. But in general terms, over the period, capex to revenue is much lower than peer averages. Working capital's on the higher side, but nothing out of the ordinary. And in terms of market cap, SunRice is now approaching Ridley and Cobram as in terms of around that $1 billion market cap level. As we go to the next slide. So this is just it's quite a lot of information on this table, but it just shows you the various metrics that we just talked about. And as I say, it's approaching $1 billion market cap or at $1 billion market cap. And interestingly, actually, the numbers are very similar to Ebro. Its biggest peer globally. So that's, working capital is almost identical, debt to equity is almost identical, EV/EBITDA is almost identical. So it is a good proxy for where SunRice can trade. As we go to the next slide. M&A, I'm sure there'll be some questions on M&A, but certainly it's right across the peer group. It's been a common denominator for stocks like Elders, GrainCorp, Ridley, particularly over the last 12 months, and even Treasury, I guess, with the US acquisition. And SunRice is no different. SunRice has recently acquired SavourLife. Pride's Easy Feed was 2021, so there has been a bit of a gap in acquisitions between Pride's and SavourLife. But again, it's very much continuing in this sector and likely to continue. And I think that SunRice will probably need to make an acquisition or two to achieve their FY30 targets, particularly given with rice prices where they are. So it's certainly something to watch out for. As we go to the next slide. In terms of valuation, there's a few things to sort of talk about here. We used to use a sum of the parts, but we found that perhaps there was just not enough sample sizes in the various divisional breakups to have it as being relevant. So and given that SunRice have clearly stated FY30 sort of revenue and margin targets, not so much specifically margins, but certainly revenue implied, we think DCF's is probably the best way to look at SunRice. And there's a few things I'd say. Our numbers don't have 8% revenue growth forecast out to 2030, and that's mainly because we think that some of that growth will be acquisition related, and it's very hard to forecast an acquisition in terms of size, timing, and so on. So our DCF doesn't have any of that in it. We're still using a beta of 1, and if you look at the betas, and again, betas, but if you look at the betas of some food and beverage companies, we had a look the other day, and if we look at LSG calculated betas, Bega, for example, is 0.9, Elders is 0.6, Treasury is 0.4, and even SunRice, I think, 0.65, but even the latest might have been a touch lower. So the betas for these FMCG companies calculated are often lower than 1, and so there's some room to move in terms of the beta. And so I think those two things are probably key to thinking about the valuation at 14.40. But again, 3 months ago the stock was $10, so the stock has rallied significantly and certainly approached our target. As we go to the next slide. And finally, just I guess a wrap up of the key sensitivities, be it earnings or valuation. Obviously, the rice harvest is important to absorb the overhead cost allocation and to utilise those assets. And at the moment, we've had sort of 4 good harvests. SunRice have invited growers to grow up to about 500,000 tonnes, depending. That doesn't mean they take it all, but invited to grow to that sort of level, and that would see ample. Arguably ample stock in the system for the next 3 or 4 years. So I think the risk of the once in a generation drought in the near term, and it's always dangerous to talk about weather in this country, but in the near term looks pretty low. Working capital, obviously, when you have a big harvest, you have a requirement to take that stock, and you can hold it up for up to 18 months. So there are working capital requirements that come with harvest, but at the moment they look to be in that Goldilocks level, arguably. 10-year bond yields obviously impact the cost of capital in the corporate division, but again, bond yields look like they're holding pretty well in that 4 to 4.5 range. Global rice trade, obviously, the guys will probably talk more about the tariffs and the various. I noticed that Ebro Foods in their latest result, they've joined sort of associations that are calling for tariffs in Europe. So there are all sorts of things going on in terms of global rice trade that could make it difficult or could open opportunities. Obviously, there's a Class A and Class B share structure, and so that's always going to be a question on that. The peer multiples, the FMCG, is certainly viewed as a staple sector for most of the players in this, and those peer multiples, over time could move higher or lower, and that affects obviously where SunRice ultimately trades, as we've seen with Ebro. They've sort of they're very, very close to Ebro on those multiples. So where those multiples move has an impact. And as I mentioned in the comments about the valuation, we currently use 1 times as a beta to calculate our WACC. If we use LSG's calculation of 0.65 at the moment, then the share price could be $20, all else equal. So that there are a lot of things that go into a DCF. That's just one of them. But there is room to move. In terms of that beta down the track as we get more delivery of results. So with that, David, that ends my presentation.
Thanks, John, for that comprehensive overview. Now it's time to hear from the company itself. You've had a great entree and a great setup from John into his views and what to look for from the company, but now it's the company's opportunity to tell its story. We're delighted to be joined by Paul Serra, CEO of SunRice, and Group CFO Dimitri Courtelis. Paul and Dimitri will provide a company presentation before we move into the Q&A. Remember, if you do have questions, submit them using the Q&A button at the bottom of the screen, and we will put them to each of the presenters at the end of this presentation. So, Paul, Dimitri, over to you.
Thank you, David, and thank you, John, for that comprehensive introduction. So if we move into the presentation, we've got a few slides here just as a recap from our annual general meeting last week, and some of you may have dialed in online to listen to that. But I thought we'd give a bit of an update, and then Dimitri will share some of the financial information, then we'll close on talking more about the strategy in the future. So importantly, this year is our 75th anniversary as a business. Started as a farming co-op in the 1950s, and we've transitioned greatly from selling the Australian rice crop around the world to what is now a very highly differentiated food business with rice at our core. But as John has pointed out, many other product ranges that we do. Throughout that history, we've continued to evolve. We've not been afraid to take bold steps, and that's really framing the 2030 growth strategy that we have moving forward. So if we go to the next slide, I think to give some context to some of what John was talking about, it is important to reflect on this slide for a little bit. So in rice, there are no futures markets, and so being able to be very diversified in where you can source rice from around the world becomes critically important to deal with price fluctuations that may happen from year to year as a result of geopolitical instability or pricing, supply and demand-led pricing levers. And SunRice over the years has developed a very diversified supply chain. We have 60% of our revenue generated outside of Australia, and more than 70% of our product now is branded and more increasingly becoming more higher value and high differentiated branded products. What that means is that we're not as exposed in our sales line to the commodity fluctuations that happen in rice. And there are large swings, as John's pointed out, that do happen in the commodity side of rice. It means that we can sell a retail product direct into a consumer's pantry for quite a consistent price. And we can have with our customers around the world the ability to pass through the fluctuation in the commodity price. And this means that our earnings line is quite protected from the top line variability that may come from the commodity price fluctuations. This is a really important aspect of what we do and indeed what a few other companies do globally. And that's really helped to give that consistent earning lines that you see. In addition to that, more and more of our products are transitioning away from the traditional bulk unbranded products into branded products. The only bulk unbranded products that we sell is essentially surplus rice from Australia into the Japanese tender markets and some from the US. Increasingly, more and more of our assets and more of our efforts are going into transitioning the remaining bulk businesses of our company into branded products, which will just further insulate both the top and bottom line from any commodity movements. We sell more than 1,500 products across the globe into over 50 countries, and we have operations in 10 countries around the world. So we're very well linked into all of the major growing areas, and from a sales perspective, Australia, the Middle East, the Pacific, and the US, they're critically important markets for us. So if we move forward to the next slide, just touching on our results from last year, and it does feel like a long time ago now that we are into P5 or the fifth period of our financial year as we talk. But we are very proud in terms of the way we've been able to absorb the top line pressures but continue to grow the bottom line. And this has really been through that shift of margin, or that shift of business away from lower differentiated branded products into higher differentiated branded products and less being sold into bulk markets. This has meant we've been able to grow EBITDA and net profit after tax whilst having a challenging top line as a result of the dropping global price for rice. So a very strong track record of performance we've consistently delivered year on year. And last year was no exception to that in what was quite a challenging environment, both geopolitically and cost-wise for the company globally. We've maintained strong cost control through the business. So as we've grown in scale, we've been able to execute synergies across our operations base, and we've been able to keep a very close handle on operating costs, which was very important as the hyperinflation environment was flowing through in the last couple of years. So I'll hand over to Dimitri now, who will touch a little bit on our segmentational performance and then overall company performance, and I'll come back and talk more about the strategy in the future moving forward.
Thanks, Paul. So if we just double click into the group segment snapshots, I won't go through all the details on the screen, but just to talk through our segments, you'll see that the rice pool on the far left delivering 370 million to the group, which makes up approximately 21% of our group revenue. And it just talks to the diversification of the business globally and away from just the Australian footprint that essentially was where the heritage commenced. And moving into the segment performance, whilst international rice coming in at 860 million was 4% off the prior period, that's to what Paul was talking about. We weren't trying to chase volume in the year that just went with the plays in the tender business in particular. The focus was really on bottom line, and you see that accretion coming in at the EBITDA line, which we essentially managed to maintain a flat number compared to the prior period, despite the revenue coming off. But when you look at the EBITDA percentages in the segments, the international EBITDA is around 6.6 to 7%. And as we move away from that bulk trading over time into more of a branded play, that's an example of where you'd expect to see some of that margin accretion coming through the mix. That's obviously our biggest segment and globally operating, so a number of moving parts in there. But again, we have a number of supply chain sources and flexibility of both assets on the ground in international countries, as well as strategic supply contracts that we're able to flex up and down accordingly. So that also talks to why the asset light footprint, we don't need assets in all of the supply chains that we're operating in. When you look at the rice food business, which is essentially all of the products that you'd either see on shelf or hopefully in kids' lunch boxes or snacks around the office, from rice cakes to rice chips. We have protein chips that we launched last year, rice flour and microwave rice, which are all products doing very well in store at the moment. And the EBITDA margin in that segment is around the 14%. So those are the types of value-add products and the differentiation that we look to continue to grow to market and hope to see growth in the coming periods. And particularly when we talk to the 2030 strategy, those are the types of products that we'd expect to continue to innovate. Moving to the right, so the Riviana food segment is essentially our artisanal entertainment platter offering portfolio. Most of those products are imported. So we're importing waffles out of Belgium. We've got croissants out of France and Belgium. We have pizza bases out of Italy. We have the likes of olives out of Greece as well. So the FX and the shipping constraints in the past couple of years have put a bit of pressure in that segment, being a net importer. But we've held revenue and actually grown revenue over the period. And very popular products. We have the most popular pizza base in the country with the Toscano brand, which continues to show strength in market, and we're gaining more market shelf accordingly with the products that we're bringing in and continue to innovate accordingly. And then Courtelis, the animal nutrition business, moving away from historically, which was a pure bulk animal feed business, into now more of a pet food style business. So animal feed is still within the base part of the portfolio, but that shift into the humanization of pets, when you see that trend coming out of COVID, the pet food, particularly dog food, is a segment that is performing well, and Save a Life complementing that portfolio, listed in our pet specialty stores like Pet Barn, Pet Stock, Pet O, etc., as well as in the agri retail segment. So you won't see those products in your main retailers, but it's more your specific pet specialty that are doing very well. And again, a number of growing portfolio products in that segment. And then on the far right, as John mentioned, is the corporate segment, which is essentially where all of the brands and the assets are positioned, and we charge the rice pool and asset finance charge. So now that we've just walked through the segments, talking to the strategy, which Paul will do in a while, we're actually looking to reformulate our segments, aligned more with the organizational design and also leading up to the 2030 strategy. But fundamentally, the products within those segments will be the same, but the segment snapshot is expected to be tweaked accordingly. So we'll look to bring that to the market towards December, when we announce our half year coming out of October. So just as you get your head around the current segment snapshot, we'll tweak that accordingly and hopefully simplify that for you at the next reporting period. So if we move on to the next page, it's essentially a snapshot of some of our key metrics. And what I'd like to highlight here on the top left graph, we've got the black line, which is highlighting the Australian crop size. And you'll see that it's been quite variable over the period of the last 10 years. Despite that, the bar chart is our group revenue, and regardless of what the Aussie crop has essentially done to us, we've been able to hold and grow our top line revenue. So when you look at the peak of the drought in FY20, FY21, we grew about 4 or 5% of our global rice demand in Australia, which means we backfilled from our international supply chains between 94 and 96% of our requirements, and we're able to deliver that to customers. So going forward, a more consistent Aussie rice crop certainly helps that profile. But again, as we've tested the resiliency of the business model, we've proven that we can come through droughts, and the business has got that growth and that resilience attached to it. And if you look at the graph on the bottom left, which essentially reflects the EBITDA and the NPAT, we've never delivered a loss. So despite the drought that was highlighted in FY20, whilst the earnings did take a hit, we're a very different business model today with the resiliency of our international supply chains and the ability to backfill a lot of that demand. Now, it's not a one-for-one in terms of the replacing that demand and adding to profitability, but the track record should hopefully demonstrate that the ability of the business to help compensate for that impact, has shown in the past. And again, when you look at the top right, our dividend profile, as John talked to, has been strong and consistent, and we've held some pretty healthy divvies over the period. And the dotted line was our dividend payout ratio, and that's really to demonstrate to the market that despite the shareholding structure, despite the droughts in FY 2021, we were able to flex that payout ratio accordingly and continue to reward our B-class shareholders, which essentially hold the stock that's listed on the ASX. And last year, 65 cent rather, fully franked dividend, and still rewarding our shareholders accordingly. And when you look at our EPS on the bottom right, growing, we're now over $1. And just touching on what John was calling out earlier, our PE ratio at the moment is around 14 times. When you look at the median PE ratio of the agri index, that's trading at about 20 times. So there is a discount there when you just compare us against those peers. And then, of course, the beta ratio that gets factored into the WACC. When you look at that beta ratio, there's also a bit of headroom that we believe to be unwound over there as well. The next slide is essentially our EBITDA and cash flow movements. And the highlight here is really on the bottom left and the bottom right that I'll talk to. The bottom left, our ROCE has continued to grow. So we look to obviously return and create value for our shareholders with a ROCE hurdle that's at least a WACC plus 1%. And again, that's been a big focus of the business, and why we're not looking to just chase revenue. It's really around the quality of that revenue playing into that bottom line and coming through in that ROCE as an example. And that has been complemented with the acquisitions that we've picked up over the last 6 or 7 years that we'll touch on as well. And then when you look at the bottom right, our debt position and balance sheet is in a very, very good place. Our core debt is essentially zero, and our debt is driven by our working capital funding. So when you look at our gearing ratios coming in at 26% for the prior period, and our leverage ratio at 1.5 times. And the next slide will show you where that's driven from. Next slide, please, which is the makeup of, on the left-hand side, our debt profile, the core debt in red and the seasonal debt or working capital in blue. We've paid down our core debt over the last couple of years now. So all of the debt is essentially driven by working capital, which is funding the inventory movements around the group. So the more sizable Australian crop that you have, that drives the working capital, and as well as our international supply chain accordingly. So with the acquisitions we picked up in the last year or 2 years in particular, we've paid that from our operating cash flow. Core debt capacity is about $200 million. So we're primed to go after some opportunities should they present themselves. And M&A has been a key component of our strategy. And again, reiterating that the debt profile driven from a working capital perspective. I'll throw to Paul to cover the strategy.
Thanks, Dimitri. So as you can see, a strong financial position the company's in through a very long track record of strong financial management. So I've been in this role now for just over 2 years, and as I came into the company, we really took an opportunity to step back and look at the future, given the strong position that SunRice was in across many different markets. And I think ultimately, John's touched on this point. We are at our best when we are a rice food company. We have the largest points of differentiation versus our competitor, and where we generate most of our economic profit from is from our integrated rice businesses. It's where our DNA is. It's where we know what to do best. It's also where we innovate the best, and that's a really important part as we start to frame the strategy up. So on our journey to become everyone's favourite rice food company, we really have defined a number of key strategic priorities. And I won't go through this slide in detail because there's a lot that sits behind this. But essentially, we have a very focused geographic play. So Australia, New Zealand, the Middle East, and the US are 3 priority markets that we're focused on from a growth perspective. We have strong positions in those markets. We have established brands with good brand equity. We know consumers, customers, we have strong route to markets, and we know how to innovate in those markets. We're able to drive greater levels of differentiation and profit coming from that growth in those markets as well, which is absolutely critical. We need to, in addition to that geographic growth, make sure we maintain our Australian rice industry presence and that we keep our assets here full, essentially. It's worth noting that only about 20% of the rice that we procure globally comes from Australia on average. 80% or above on average of the rice that we procure and package into different types of products around the world come from outside of Australia. And that's really speaking to the diversification that both Dimitri and I have touched on. And then within our adjacent portfolios, really driving those to full potential. So Riviana, Toscano, and the pet food business here in Australia have a lot of good potential for us. They're very contained within an Australian play, but they can generate a lot of profit for us. So we have a very clear strategy. We understand what we need to do to bring that strategy to life. And in doing so, achieving our aspirational targets of $3 billion worth of top line revenue, along with margin accretion as we go down that path. And we can come more around M&A and the importance that plays in it later. But that's a quick snapshot of our strategy, and it really forms the key part of how we look at all things at SunRice. Moving on to the next slide, talking briefly about outlook. Our outlook for FY26 remains consistent. We expect to build on the solid results that we did achieve in FY25 and show growth at both the top and bottom line. As we mentioned here on the page, and as I spoke to last week at the AGM, there are some challenges that remain. Being an international business exposed across many different markets, there will always be challenges. But we are experiencing increased competition from lower priced offerings in developed markets in particular. And that's placing pressure on revenue and margins. However, as we've said, the innovation and the growth that we're experiencing through greater differentiation is helping to offset this. We do have a weaker Australian dollar versus the Papua New Guinean kina, so the translation loss is coming back into the P&L. There's some impact from that. And we continue to see the inflationary pressures on cost of living, particularly in developed markets, and that playing into the top line number. But as we say on the page, and as we said last week, our outlook remains positive, and we do expect to build on those results that we delivered last year, both the top and bottom line growth. Finally, there's been, John touched on the importance of the Australian rice crop. So if we move to the next page, we do have a number of our assets sitting here in the Riverina. So it is important that we continue to have good quality rice flowing through these. And our Australian rice is very highly sought after in markets such as the Middle East. So in CY25, we had a good crop coming in about 511,000 paddy tonnes. So we have full storage facilities at the moment. We expect, obviously, from that to have a full milling program this financial year. And they're both very positive factors for the business. Overall, for the farmers, the quality was not quite as good from the CY25 crop. There was a really dry finish to the year, and so there was quite a lot of cracked product. That will flow through to a lower paddy price for growers. And so we're maintaining the range of the paddy here from $380 to $450 per paddy tonne. And in CY26, we're really approaching the planting window as we speak. There's rain happening down in the Riverina as we speak. And so really we're monitoring the conditions closely and looking for a good response to planting rice this year. But the next couple of months really are going to be critical for how that crop shapes up and then the impact that might have in future years to the business. So with that, I might close and allow plenty of time for questions. I really hope we get some great questions and look forward to answering them for you.
Thanks, gents. A comprehensive presentation and clearly a diversified business that is, in the footy parlance, kicking goals all over the place. So congratulations. I will now open up to the Q&A session. As I mentioned, if you do have any questions, submit them Q&A using the Q&A button at the bottom of the screen, and I'll put them to John, Paul, or Dimitri as appropriate. Now, I will quickly welcome John back. There are a couple of questions of him. John, rice is clearly a core differentiator for SunRice. With global rice prices easing, how is the company positioned compared to global peer Ebro Foods?
Yeah, look, to be honest, I don't know Ebro's business as well as SunRice's, but I think the table that we show, the table about the both groups managing, both groups seem to be managing that revenue, that lower prices, and been able to hold their margins or improve their margins. So yeah, look, as I say, I don't think there's. I think what Ebro is showing is what SunRice is showing, but both players are. But there's slight differences in the businesses in terms of their market exposure. Ebro is obviously more exposed to Spanish harvest and SunRice is Australian harvest in terms of their own product. But yeah, look, I don't have a strong view other than to say that both are managing the price declines very well. When you're considering the prices rose so sharply and fell so sharply, to be able to manage, to be able to hold earnings in that environment, it shows the big players, I guess, with the diverse sourcing, can do it.
And looking ahead, what do you see as the biggest sensitivities for investors to monitor? Is it harvest levels, working capital, or the cost of capital?
It's a good question. I feel harvest levels. I'm no weather expert, but I feel harvest levels are pretty well under control in the near term. Bond yields seem to be, relatively stable. Certainly nothing that's going to cause that WACC to go down significantly, anytime soon. So I feel like they're sort of relatively, stable, as stable as you can get. So I guess for SunRice, it's really the ability to deliver innovative products, and probably the risk is, as they say, as rice falls, there's ability for sort of less weaker players in terms of balance sheet to be able to maybe come into the market, because rice is cheap, so they don't need as much working capital to play, and obviously that ever present danger of private labels, but that's less of a case when you've got innovation in product. When you're producing, microwavable Hawaiian rice or something that's unlikely to be a private label product. So the big, so it's probably more peer multiples and but yeah, it's probably peer multiples at the moment.
And the business does have a history of acquisitions. How important is M&A to their growth strategy relative to organic initiatives, in your view?
Is that for me?
Yeah.
Well, I think there's no doubt there's no doubt. I think that it's highly likely that M&A is going to be required to achieve those 2030 targets, unless there's like a massive, and there has been a real pickup in product innovation and product launches, which is organic growth. But one would think there's a couple of largest M&A deals required. So I think it's relatively important. It's going to be important to those targets, I think.
Paul, Dimitri, welcoming you now. Just touching on that, what are the key focus areas for M&A, and are you seeing many opportunities out there?
Yeah, so I mean, first and foremost with M&A, you need to have a really clear North Star. We have a very clear strategy. We're very clear about where each of our brands sits within each of the markets that we're looking to grow. We understand the size of the markets, the complexity of the players, the profit pools, the type of products that would be necessary for us to grow within those markets. Each of them are at a different stage of maturity. If you think about Australia versus the Middle East versus the US, what will be needed in each of those markets for us to grow and achieve our aspirational targets is slightly different, dependent on our positioning there currently and the competitive environment of the markets. In Australia and New Zealand, we'll continue to look at opportunistic M&A. I think we have a very strong suite of businesses here already. We have a very strong branded presence. We understand the customers well, the route to markets and consumers. So I think organic growth in Australia and New Zealand marketplaces will continue to play a key part of our growth picture. If we look to the Middle East and to the US, there's opportunities here for us to look at both organic and M&A more strategically. And particularly where M&A gives us the ability to leapfrog in terms of scale, route to market scale, or consumer branded presence. And again, they're very different markets, and so targeting very clearly how that M&A provides a strategic benefit and helps us achieve our strategic goals faster is a key overlay to that. But there's certainly opportunities, and we're certainly looking at how M&A fits together with organic growth to give us the overall profile and aspirational targets that we're looking for.
And talking about organic, within the current portfolio, where do you see the best returns on investment opportunities?
Yeah, I'll take that one. So essentially, when you look at the branded play, Toscano is one of the core products within the Riviana segment that's doing very, very well. So that's the pizza bases as an example, and brioche and croissant style products offering that have responded very well in markets, and we're seeing some very healthy double digits growth in that segment, and are looking to invest behind that brand, and will continue to do so, and respond accordingly to the market. And then you look at other areas within the segments of our portfolio of CopRice in SavourLife, and the branded pet food in particular doing very, very well. And again, it's that step change to your branded products, and it's the differentiation of the product portfolio. We're not just looking to drive more price. It's that product offering that's going to make a difference for the consumer, and one where in an innovative pipeline where we're continually inventing and looking at types of tweaks of products that we can bring to market, particularly in the rice space. As Paul's and I've said in the preso so far, rice is at the heart of what we do. So the rice segment growing in terms of the types of products that are either adjacencies to rice or within core rice, from a branded differentiated play. We have some new products like the risotto style rice that you're literally adding water and a protein, and you've got an amazing meal at home, as opposed to struggling to try find a recipe for risotto, which is not a straightforward rice varietal to cook. So we've also made that easy. And again, as consumers become more time poor, the offering that convenience is a big segment that we're looking to play in as well. So the response has been there between the rice play, the Toscano brands, the pet food brands, particularly SavourLife, and we'll look to continue to invest behind those segments accordingly.
Well, SunRice has set an aspirational target of reaching $3 billion in revenue by 2030. You mentioned it in the presentation. Can you update us on the key levers to achieve that target, both organically and through acquisition?
Yeah, we've touched on some of those already. So the key geographical regions we see most growth coming from is Australia, the Middle East, and the US. And we see most of that growth coming from rice-based products, with most of it within rice coming from more value-added, differentiated rice-based products. So you've seen us launch a lot of products in the last 12 months. Dimitri's referenced some of them that are taking us away from what I just say is a bag of rice on the shelf. It's taking us into providing and unlocking experiences for consumers that they're willing to pay a premium for, and we can extract a premium from that by offering value in a very different way than straight price. We will not win versus private label by offering value in price. We have to offer value in terms of convenience and those other things that we can unlock for consumers. So we think organic growth will play a key part. It's worth noting that our brands in the Middle East, for example, have been in market for more than 30 years in many markets. We're the number one medium grain rice or number one rice player. And so we have strong equity to build off as well. And so differentiating those categories, adding a lot of what we've done here in Australia into markets like the Middle East, we're seeing really strong take up and growth on. And then in the US, we have quite a nascent consumer business there. But in terms of the differentiated products that we have and also that we're looking to launch, we think we've got quite a lot versus what's in market in the US. And I've lived in the US for a long time as well. And I think it's quite exciting about some of the direction that we've got. Now, the US is a great example of where an acquisition may help us get to scale faster, particularly if we think about the US as different geographic regions. It's a large country, and it's I think dangerous to think about it as one homogeneous kind of mass from a consumer perspective. There are big differences throughout the country. So for us, thinking about acquisition along with those organic growth opportunities in the US may be one area that helps us move to our strategy faster.
Question here about integration of all the different businesses into an effective organisation, an efficient organisation. Are there integrations in place such as common IT infrastructure, integrated accounting, common receivable systems, payable systems, etc., that bring that efficiency to the business?
Yeah, I might talk the structure of the business internally first, and I'll hand over to Dimitri, who actually also looks after a lot of our IT and services. But we didn't touch on it in the presentation, but we have reorganized the entire internal organization behind this strategy, and that will be leading to a slightly different segmentation, which will Dimitri's touched on, which will communicate in due course. We have been very clear to make conscious choices to realign the organization to deliver the strategy. I think many organizations fail to deliver their strategy because they don't make the internal changes necessary to execute against it well. So I think we've done that very well now, and we're through those changes and operating really well in the new business environment, which we'll update in due course. And I'll hand over to Dimitri to talk more about systems processes.
Yeah, extracting the data to drive insights is absolutely fundamental. So if you take an example of the ANZ business, we had the RAAS Food business, the Riviana business, the CopRice business, essentially 3 different business teams, all dealing with the same retailers, all reporting their numbers in slightly different ways. So the ability to extract synergies and commonality and customization behind the scene that you're addressing to actually address that and find those cost savings, but the efficiencies being the front and center in terms of what it is we're going after. And particularly when you look at that North Star of that aspirational 3 billion top line number that we're looking to go after by 2030, getting the team aligned to that and coming to the market in a much bigger and stronger way as a larger business unit, as opposed to a subset of 3 or even 4 suboptimal size segments, is also playing into that. So we're literally 4 months or 5 months into that commencement of that journey, but we would look to obviously build on that. But the platform itself is strong, it's in a good place, and it's enabling us to grow from here.
And we do have common ERP systems, payment systems across the board, correct? So we're using SAP, for example, across our businesses.
Dimitri, just another question for you. Sorry, go on.
No,
sorry, Dimitri, I was just going to say your rice food and CopRice divisions delivered margin expansion last year. How sustainable are these improvements, and what further efficiency gains are possible?
So I'll knock off CopRice first. So that was the first year of Save a Life coming into the business. So that certainly injected a breath of fresh air into that segment, and that step change away from the bulk ruminant side of it and more animal nutrition branded. And that's certainly something that we'd look to double down in going forward. So the pace of growth, it's really around ensuring that we're delivering that close to double-digit EBITDA margin, which we were essentially just there last year, and with a full year of Save a Life looking to repeat that. But we still have a large ruminant business and some big chunky mills in Cobden and Tongala in Australia. That utilization and efficiencies are important to soak up overheads and drive that margin coming through. So over time, again, it will be that continued move away from the bulk play into a more branded, differentiated play. But that will obviously happen over time. And then on the rice food business side of things, not too dissimilar. Again, with the number of products that we have launched coming in and helping that EBITDA accretion as we look to cycle those through and get those annualized earnings coming through. Hope to expect that to continue. And again, launching new products as well. So there will be a lag between the launching of those products before we get those run rates coming through. But the pipeline is full, and that's probably the most positive thing to call out, that there's a number of exciting opportunities and products that we're looking to bring to market. Some we have already launched and others that will follow suit, that will then help to drive that return accordingly.
Just touching on Save a Life, which you mentioned, and probably Simply Delish as well. So two businesses integrating into the overall business. Firstly, how is that integration going? But secondly, what role do these acquisitions play in diversifying the portfolio and delivering earnings growth?
Sure. So the diversification we've spoken about quite a bit already, and again that continuation in diversification to earnings, but again remaining close to your rice and rice related products is key. SavourLife we felt was a very good bolt-on into our animal nutrition business, and integration wise has worked very well. And again we've in the past, when you look at how we've been trading from a share price perspective, buying acquisitions that are EPS accretive has been a challenge, but now with a little bit more room to play with, that essentially opens up a little bit more opportunities that we could potentially look at to ensure that we're bolting on something that would be accretive sooner than later. So, but having said that, SavourLife has been a great acquisition. We're very pleased with what we've purchased to date. With Simply Delish, integration challenges, we're working with the business, and we were partnering with that business for about 5 years now, because they did produce some of the products in our Riviana range. So the bolt-on was naturally moving up the supply chain to essentially manage the assets right through to the products under one roof, instead of dealing with a co-manufacturer. But that is a relatively small component of the portfolio, and that's why the ticket price was much smaller accordingly. So again, over time, the integration of all of the acquisitions so far, we on balance are quite pleased with, and it's enabled us to build that sustainable growth platform and the consistency of earnings in a diversified play, both locally and internationally, that will continue to look to grow.
Just a question in terms of last couple of questions, because I know we're almost over time. With other food sellers in supermarkets where you've seen price increases at the retail level, where is food inflation at and prices relative to key cost of products such as labour, energy costs, etc.? Are they a long way behind? Are they capturing? Where are you seeing that discrepancy, and how are you capturing that?
Yeah, so I think food inflation has come off quite a ways, along with a number of inflation items in the last 12 months through a retail environment. We've certainly seen retailers shift their focus to far more value as inflation has come off, and as the cost of pressure and the cost of living pressure over time has stacked up for consumers. And so we really see that playing out on shelf with private label offerings, in particular with companies like Aldi coming in with cheaper products that Woolworths and Coles then follow. We see that sort of less differentiated aspect of the categories, and it doesn't matter which category you look at here, it's almost unanimous across all food categories. That less differentiated end of the category declining fast, and so we're no different in terms of the categories that we operate in. I think what's really important here is to capture growth in an environment like Australia. You have to offer something to consumers. You have to be able to communicate that clearly, and your product needs to deliver. And I think that's what we do well, and it's what good CPG, FMCG companies do well. And you're able to then capture more of the profit in the category by offering consumers something that they can't get through straight price on the less differentiated end of the category. So when we talk about moving higher up in the differentiation curve, it's to enable us to get to that part of the profit stream. And that's what we're doing in all of the categories that we're in. It's why we're confident we can continue to grow margins. The other thing is that 60% of our revenue is outside of Australia. So we're not solely exposed to the trading environment here in Australia, which I think is a key part of our resilience versus peers that are traded here in Australia at least as well.
A capital management question. The dividend reinvestment plan had about a 50% uptake in full year 25. How do you balance capital management between reinvestment for growth and maintaining dividend appeal for shareholders?
Yeah, good question. So when you look at the profile, dividend has been an important part of the story to reward our B-class shareholders, and all things being equal, we'll look to continue to deliver on that mandate. The balance sheet is in a good place, and as I called out, our core debt is zero. So we have the ability to go after accretive acquisitions as they present themselves. Reintroducing the DRP also enabled us to, we actually underwrote $10 million of the dividend in the DRP program, and we got about 7 new institutional investors onto the register. Fast forward to today, we've got about 30 different instos on the register. So we are starting to see that step change in the share register, which is pleasing. and liquidity as a result picking up. And then to what John called out earlier, entry into the ASX 300, which was great news that we received on Friday. So balancing the debt and equity is paramount to what we do. On the one hand, strong balance sheets, debt capacity to go after things as they present themselves. But now starting to look at that equity side of the channel that is becoming more and more valuable, and we'll continue to apply that discipline going forward. At the end of the day, acquisitions need to make sense. EPS accretion is important, and we'll balance debt and equity accordingly.
Yeah, I think just to add to that, Dimitri referenced it earlier. I think when we look at the equity side of raising capital, we're starting to get to PE ratios that are closer to our peers. And so some of that may make sense, but we still, I think, have a ways to go to release fair value towards our peers. And we'll also take that into consideration as we move forward.
Last question, and it's similar to the question that I did ask John a little earlier. From an investor point of view, there's a lot of metrics or milestones that they could be looking at to determine whether the business is on the right path and achieving the goals it's setting. When it comes to an outward-looking metric, what do you think investors should look at over the next 6 to 12 months as measures of success that the business is driving towards delivering the strategy that it's set?
Yeah, I'll touch on my versions, and Dimitri can bring his own voice to that. I think for me, the external metrics that I would be most interested in following is the continued margin accretion to net sales. I think whilst we've set a very aspirational top line for us, and a lot of companies can go by top line, what we're trying to do is drive margin accretion through the value-added nature and the higher differentiated nature of products that we're launching and businesses that we're looking to get into. These are not short terms. That may not be the next 6 months. These are proof points that over time we continue to do. And I think we've proven the last couple of years that despite contraction in volatile rice markets, we're continually growing margins. And that's because we're not selling a commodity, we're selling a consumer product that makes its way to a pantry in a higher differentiated way.
And I'd certainly be repeating margin accretion being fundamental in that roadmap to 2030. And then obviously keeping a very close eye on the likes of EPS accretion, divi yields, and factors in depreciation, capex, etc. So all things that we've been monitoring for a long time now, and would continue to do so into the future.
Thanks, gents. Well, that does bring to an end the Q&A section of today's webinar and the formal presentations. There are a couple of questions, a couple of them are quite leading questions that I don't want you to get in trouble with the ASX by trying to answer. So we may look at those offline, and if we can answer them, though we will. But firstly, to Paul and Dimitri, thank you for your time today, not just for presenting what is somewhat a standard presentation, but really opening up as to the business, answering the questions put before you, and giving clear insights into what lies ahead. So thank you, gents.
Thank you. Thank you. Thanks for joining.
And thanks again, John, for your insights and for setting the scene. And just reminding people, the research John has recently released is available on the RAAS Research Group website. So, John, thanks to you.
Thank you. Pleasure.
And this does conclude our RAAS Stock Take webinar on the SunRice Group. We hope you found today's session valuable in deepening your understanding of the company and its investment proposition. On behalf of RAAS Research Group, thank you all for joining us, and we look forward to welcoming you